Xi Jinping takes a third term and Chinese stocks fall more than 15% on the day. That's what I'm going to cover in this video. So as you guys smash that like button, let me run the intro. What's up, guys, and welcome back to the channel. And so there's a lot of news on Alibaba and just Chinese stocks and China in general today. A lot of people took some huge losses in their portfolio, and some of you guys were actually mentioning in my comments for other videos that you wanted me to do a video on Alibaba today. Of course, whenever there's a move this big, I'm gonna do a video anyways, just to sort of like reiterate what my thesis is and let you guys know what I think of the new news that has come out. So let's dive right into this one. So you guys can see here that Alibaba actually fell to under $60 per share today intraday before recovering to around $63.15 per share. And I could see more downward pressure as time goes on because people are really worried about the fact that Xi Jinping is becoming less capitalistic and more sort of embracing sort of like a Marxist perspective or sort of like a state-controlled perspective or state power. And so many people are now saying that China is becoming less investable, and I understand their opinion. And you can see that I just saw this on the front page of Barron's today. So it did say that Alibaba, Tencent, and other Chinese stocks are in free fall, and it's all about Xi Jinping. But I think the real issue and what spooked a lot of investors was sort of like the removal of the former president, and you can see it here. Out of sort of like the CPC meeting. And that's kind of a little bit troubling to investors because you're moving more to seeing China as sort of like a dictator-led country, at least from the perspective of the Western media. I'm still waiting to see exactly what they do before I pass judgment here because I'm not seeing enough evidence to suggest some of the accusations that Western media people are levying towards China at the moment. And this is kind of what we're seeing in our local newspapers. So this is from the Barron's article that I just mentioned. So the market has reacted to the consolidation of power by Xi Jinping. And of course, you guys know, and we've discussed this on the channel many times, that he was expected to break with the historical precedent and pursue a third term. And of course, that makes him the longest serving leader since Mao. On the left here, you can see that the Hang Seng Index fell by 6.4%. So it was its worst day since 2008. That's nuts. And of course, people are worried that the sharp consolidation of power is adding to the investor unease. And really what's happening is because this is all happening, investors are largely demanding a higher risk premium to be investing in China. Look, investors have always required a higher risk premium. This is why you can't compare multiples when you look at something like an Amazon or a Google and compare it with like an Alibaba or a Tencent. And so the risk premium has always been there. And it seems right now, because there's a lot of sort of like uncertainty, they're going to be demanding a higher risk premium in this environment. But like I always say, these are the times where you could potentially generate high rates of return. Now, guys, I always talk about the risks of investing in China. And so if you guys have been following this channel for any length of time, you guys do know that I talk about the real estate crisis, I talk about the unemployment issues, I talk about the slowing China. And so as we're getting to the end of the year, recall last year, I actually talked, or I made a video about some of the risks that would be facing China in 2022. It's actually funny. The one risk that I thought would be sort of like the least important risk was continued COVID lockdowns. And in fact, that actually ended up becoming the biggest risk and the biggest overhang on the securities markets as it came to investing in China this year. And so here are the emerging risks that we should be thinking about as we move into 2023. The first one is, of course, continuing lockdowns. Of course, that one has moved right up to the top of my list. And based on what has been said in these meetings that have occurred over the past week, it doesn't look like the continued lockdowns are slowing down in any time soon. The second risk that you should be concerned about is the slowing economy, not just in China, but globally, and how it will impact China. The third item, and this is something interesting, is that we now have the return of common prosperity. And so what I want to know is what exactly does that mean, and how does that impact how companies operate? If common prosperity means that companies like Alibaba can no longer buy back shares and they have to reinvest that capital into sort of like common prosperity measures, that's where I draw the line. I'm no longer a bull on Alibaba. So if you guys wanted to know what would cause me to sell my shares, that's what would cause me to sell my shares. If you're not allowing business people to control capital decisions on their own, then that's not a place for me to invest. So I'm going to be paying close attention to what exactly they mean by common prosperity. Last time, the companies were able to just invest in capital programs that benefit themselves and call it common prosperity, and then the CCP backed off from common prosperity. So we'll see what happens here. Now, there are two offsets here. The first offset is a lower yen. So, of course, lower yen should be good for exports. We'll see how that plays out. The second offset is, of course, continued buybacks. So if Alibaba shares are lower in this environment, they will be able to buy back more and more shares. And I'll talk about more on that later in this video. But now let's go into some of these items. The first item that I want to talk about is that China's GDP has been declining over the past 10 years. You can see the chart right here on the right. And my question is, could it sustainably return to around 6% a year? Or are we doomed to have it under or close to around 4% a year? And so would we have to adjust our models? Because recall, guys, that my Alibaba model is assuming that the Alibaba China segment grows at around 7 to 8% a year. And that's based on the fact that I expect the Chinese GDP to grow at around 6 to 7% a year. So if the Chinese GDP starts growing at around 3 to 4%, then I would have to adjust down my growth expectations for the Alibaba China business. But of course, even if I were to adjust that downwards, it still would just bring my valuation down to approximately like $200 per share, not $240 per share. So you're still looking at a grossly undervalued company. And so the reduction or permanent reduction in the GDP is offset considerably by the current share price of Alibaba. So this is not a risk going forward because it has already been reflected in the share price. And you can see economists, although they have cut the China's GDP for 2022, notice that in 2023 and 2024, they're going back to around that 5% area. So if you're back up to that 5% area, then, you know, it looks a lot better for Alibaba than if you have to reset that to closer to 3 or 4%. But what this also is doing is it's reflecting the fact that everyone, including economists, are taking a more cautious outlook towards China. So this is where I would say that there is some upside potential here, because if things improve drastically, you could see revisions cause the Chinese securities to surge, but you are not going to have that until at least they walk away from their COVID protocols, which they're not showing any intentions of doing so right now. And you would have to have a stabilizing global economic perspective, which right now we're not seeing because inflation is still roaring even in the Western world. And you can see that we, of course, have surpassed the point where economic costs have far exceeded the benefits for the COVID lockdowns. And so you can see that Shanghai in the past year was locked down 92 days, followed by Dalian, guys, correct me in the comments if I pronounce that wrong, with 64 days, and Liaoning. And then, of course, Beijing was locked down 57 days. So huge lockdowns for many of these cities. If this continues into 2023, you're still going to have a lot of pain, and you're not going to have a recovery in the share prices for Chinese securities. And so this is why this is a risk that I'm continuing to watch. And this is why I believe that this is a risk that you need to continue to watch. Notice that in the meetings that they just had, the message largely reiterates everything China is already doing without signaling significant changes in economic and coronavirus policies. So if you're worried about how they handled the country and the economic policies in 2022, they're essentially signaling that more of the same will continue in 2023. Now, I would say that a lot of the things that they have done in 2022 have been good, but there are risks, and I've covered those on previous videos, but largely I've also provided 6 solutions, and I will actually link to the video where I provide sort of like 6 solutions for the Chinese economy, and I do hope that they pursue many of those, and because if they do, there's a lot of upside in my opinion. And a lot of people are making a lot of hubbub about the return to common prosperity. And I would say that despite the fact that they have signaled for more robust regulation to evenly distribute the spoils of China's rapid development, that does sound very socialistic to me. The devil is in the details, because would you walk away from what made China successful over the last 20 years, especially if you want China to become or overtake the US in terms of economic power or GDP in the next decade? I really believe that the devils are in the details here. I think common prosperity is more of a political talking point than anything that they're going to do to go against entrepreneurs. I think what they're really going after here, if you were to look at what they've done historically, or at least in the past 18 months, is they want to go after any of the entrepreneurs that use their power to sort of like hurt society, not necessarily go after entrepreneurs that are benefiting society. So like companies like Alibaba, I think, are safe because they're focusing on areas that grow the wealth of the country as a whole by focusing on grocery. And I think the entrepreneurs that would be in the crosshairs would be the entrepreneurs that are sort of like exacerbating sort of like the real estate issues. And so once again, devil's in the details here. I'm not scared just yet, but this is something that I'm looking into and following closely. And as there are new developments, I'm going to be putting them out on this channel to help you guys sort of navigate this environment. And once again, I said that, you know, the Chinese yuan falling to the lowest level since 2008. This is a bit of a good news. This is going to be good for exports. So pay attention to this, guys. We'll see how it plays out. I did see an article that I haven't read just yet that said, you know, that yuan falling might not necessarily be the boom that you expect it to be. And so I will sort of read up on that, do my research, and if there's anything to report to you guys, I will let you know. Now, this is a question that you guys are all been waiting for. Is it time to sell Alibaba in this environment? And you know what? I am still a proud owner of Alibaba. I believe that they have a ton of value to offer to the Chinese economy. I am especially proud of the China commerce business and the Alibaba cloud business, and I'll show you exactly what I mean by that. So notice, total China commerce, I expect that business to grow out at approximately 7.5% a year into sort of like 2032, so the next 10 years. The cloud business, although Alibaba expects the Chinese cloud business to grow at around 35% or so, I just can't remember exactly what the number was, I'm growing at around 15% a year. So there's a lot of upside there, but I'm being very pessimistic in my valuation. So overall, I'm expecting Alibaba's revenue to grow at approximately 8% a year. And notice, guys, that in this environment where Alibaba shares are going down to $60 per share, notice that Alibaba has been buying back shares as they have been declining. This is absolutely accretive to shareholders, and this is the only thing that I would expect them to continue to do in this environment and help us all who've sort of had like the diamond hands, so to speak, in this environment. Look, I'm not selling my shares. I really believe in the company. I believe in their long-term competitiveness. I believe that they're important to China, and I believe that China is important to the global economy. And so I'm holding on to this, and I love the fact that Alibaba has become a buyback machine. They have a lot of excess capital. I have showed you on a previous video that the excess capital amounts to around $44 per share. So that makes up around 2/3 of the current share price. And so I'm a huge owner, and I will be looking to triple down on this name. And guys, don't forget, they're not just depleting the capital on the balance sheet. Alibaba remains a cash flow generating machine. And so this is why I'm still such a bull on the company. Look, things are getting tougher as the economy is slowing down, but that's not just China. It's America as well. It's Canada as well. It's Europe as well. So look, we're all going to navigate this together, but the bad times are not going to last forever. And so you want to be aligned with the best and strongest names in this environment. And that's why I'm still a huge bull for Alibaba. And recall, guys, that earlier this year, Alibaba upped their stock buyback program to $25 billion. And so if you take that $25 billion and apply it to the current market cap of the company, that reflects 15% of the current market cap. And if you don't think that they're using that market cap, well, I just showed you how they bought back around 14 or 15 billion already. And so they've used a lot of that, and they're going to continue doing it, in my opinion. And so overall, you can see here that with a terminal discount rate of 11.5% and a terminal multiple of 20 times earnings, I'm valuing the company at around $240 per share. If you were to say that, listen, the China commerce business is not going to grow at 7.5% a year, and you rather grow it at around 5% a year, it will still be worth around $200 per share. Compare that to the current share price of around $60 per share, and the company is extremely cheap. Notice here that the excess cash is around $41 per share, so 2/3 of the current share price of the company you're getting is just excess cash. And so the Alibaba at around 25% of its intrinsic value is insanely cheap, and this is an environment where I might actually be looking to buy call options, so like naked call options, but we'll see what the pricing looks like. And if I do decide to do it, I'll let you guys know. So that's what I think about Alibaba in this environment. I'm not wavering at all. My biggest worry today, as my Alibaba portfolio was going down, or my Alibaba position was going down, is what is for dinner? Because I really don't care. I've been through this many times. Remember, I started investing in 2002, 2003. We've gone through many roller coasters before. I always look at the strength of the company on its own. I do believe that you guys are right if you say that China is a tougher environment to invest in. I do agree with you there. But I do also believe, just in my opinion, that Alibaba is still a strong company. And look, you are free to disagree with me. And let me know in the comments why you disagree with me. I'm always open to changing my mind. And I have changed my mind on many situations. And I always admit when I'm wrong. I really thought at the beginning of the year that the COVID lockdowns were not going to be as big of an issue in 2022 as they were in 2021, but we stand corrected. The other risk that I didn't bring up in this video, but I will bring up in the next video, is the potential for war over Taiwan that's becoming more and more realistic. That's a whole issue on its own, and I will talk about that later. But I will link over my shoulders the video where I discuss sort of like the solutions to some of the challenges that China does have to undertake. And so I highly encourage you guys to take a look at that video. I think it's very important to gauge your understandings and also help you navigate some of sort of like the bad news you get without sort of like the full context. And so I'll leave it there for you guys. I hope you guys aren't too worried. And so I'll see you guys in the next video where I talk about the war and I talk about sort of like how I'm thinking about navigating this as I triple down.